Hey everyone, welcome back to Corporate Decoder, the channel where we sift through the corporate jargon so you don't have to. Today we're diving into Encore Capital Group's latest 10K. And let me tell you, with global financial instability still making headlines, this report is like trying to predict the weather, only with more numbers and fewer clouds. So what's the big story? Encore, a major player in debt recovery, is navigating some tricky financial waters. We're going to break down how they're managing their debt, what risks they see on the horizon, and whether they're still a good bet in this economy. First, who is Encore? They're not your typical corner store. They're a big international company that buys up debts that people haven't been able to pay. Think credit card debt, loans that have gone bad. They then work to collect those debts. They're big in the United States and Europe, especially the UK. They have US operations called MCM and European operations called Cabot. To survive in the debt collection business, you have to be good at a few things. Encore thinks they have an edge because of three things. First, they claim they are good at using data to figure out which debts are worth buying. Second, they say they treat consumers well, which helps them collect more debt in the long run. Third, they understand the complicated rules and regulations in the debt collection world. It's important to note that even though both their US and UK businesses deal with debt, they operate under completely different regulatory systems. The US has very specific rules for dealing with customers. The UK relies more on broad principles, trusting companies to figure out how to meet the goals of regulators. So what's Encore's game plan for the future? They're mostly focusing on the US and UK since those markets are more stable, but also focusing on France and Spain. They want to invest in new technology and follow the rules. They also talk about keeping a strong balance sheet, which basically means managing their money carefully. Encore makes money by buying up debts. First, they find opportunities to buy debt portfolios from banks and other lenders. Then they use fancy math to figure out how much the debt is worth. Finally, they try to collect as much of the debt as possible. Once they buy the debts, they have several ways of getting people to pay. They send letters and emails, make calls from call centers in the US, India, and Costa Rica, offer online payment options, and even take legal action. Moving on to government regulations, it's clear that Encore is walking a tightrope. Both in the US and UK, the rules of the game are complex and always changing. In the US, they're under the watchful eye of the Consumer Financial Protection Bureau. The CFPB keeps a close watch on debt collectors, and Encore has had some past run-ins with them. In 2015, they had to settle with the CFPB over how they were collecting debts. While they have settled that, the legal climate remains a threat. In the UK, it's the Financial Conduct Authority that's keeping them on their toes. This agency is constantly updating its rules to make sure companies treat customers fairly. Let's talk about the people who make Encore run its employees. As of the end of last year, they had around 7,350 employees, with most of them working outside the US. The company says they're committed to treating their employees well with good pay and benefits, training programs, and an inclusive work environment. Financially, the report shows that the company faced some challenges. The market value of the company's stock held by non-affiliates was almost $968.5 million. Total revenues hovered around $1.3 billion, which is great to see. They had a net loss of over $139 million, so this needs some work. Looking at the expenses, the company had to write off $100.6 million in what's called a goodwill impairment, and they had some pretty big interest payments on their debts. They hold about $3.7 billion in debts. They also face some external market factors that can affect their financials. For example, because Encore operates in different countries, they're exposed to currency risks. When the value of the British pound or the euro changes compared to the US dollar, it can impact their profits. They are also exposed to variable interest rates, meaning they may need to spend more for capital to run their business if these rates change. One of the biggest risks they face is cybersecurity. Because they handle so much sensitive customer data, a major data breach could be a disaster for their reputation and finances. If they don't protect their computer systems, they may lose a significant competitive advantage. And like any company, Encore faces risks from making acquisitions. If they buy the wrong company or can't integrate it properly, it could hurt their bottom line. It's also worth noting that one of their top executives, Ryan Bell, president of MCM, recently set up a plan to sell some of his stock in the company. This could be for personal financial reasons, or it could signal something else about the company's future. We don't know for sure, but it's something to keep an eye on. Looking at how Encore handles cybersecurity, it seems they have a comprehensive team for assessing and managing risks. They have their Chief Information Officer, Chief Risk, Strategy and Compliance Officer, and their General Counsel. These individuals, by way of a committee, oversee management's implementation of their cybersecurity risk management program. Based on their assessments, they claim that while cybersecurity incidents have occurred from time to time in the normal course of business, they are generally immaterial. Alright, that was a lot and we've only scratched the surface. But what does it all mean? Encore is in a tough business. Collecting debt is never easy and they face a lot of scrutiny from regulators and consumer groups. They are taking a consumer-focused approach which has paid dividends for them with certain major credit providers. There's a number of external risk factors the company may face, such as market factors, economic factors, and also the risk from cybersecurity incidents that could have a material adverse effect. The company does highlight a good risk management program to help mitigate this concern. The key will be to see if Encore can keep growing their collections while also staying out of trouble with regulators and dealing with macroeconomic conditions. If Encore can maintain its current strategies and make smart acquisitions, then it seems like they are on track for future successes. So, what do you think? Is Encore a debt-collecting powerhouse or a house of cards? Let me know your thoughts in the comments below. And if you found this breakdown helpful, give us a like and subscribe for more corporate deep dives.